This is the last talk of today, so I understand everybody's tired. So please bear with me a little bit more. I have a lot of interesting stuff, especially from a venture capital and startup perspective, looking at advanced air mobility, of course. And today I'm going to be talking to you guys about three things. Number one, I'm going to be giving you the state of funding in advanced air mobility and the financial health of the ecosystem. Number two, I'm going to try to convince you why early stage startups are the best positioned to have a long-term strategic exit for advanced air mobility when we look at 7 to 10 years ahead. And finally, I'm going to be giving you guys three different areas that we see as potential areas for investment that's going to make a big impact on AM in the long term. All right, so let's dive straight into the state of funding. In the last 10 years, if we look at the whole advanced air mobility ecosystem, we've garnered around $18 billion in investment across 600 different firms. And this includes everything from the smaller drones up to the larger eVTOLs and all the enabling technologies such as UTM, vertiports, flight systems, autonomy, etc. So, it's not that big. If you look at AI, it's more than $500 billion in the last 10 years. We obviously need more, but this is where we are at today. Let's look at the passenger eVTOL companies. There are about 40 firms out there that have been funded through the venture capital way. And we see more than $8 billion that has gone into these companies. So a bit less than half of all of funding that has gone into AM. As Dr. Eric Lind, touched on this, the eVTOL OEMs have an outsized investment that they've been able to attract compared to the others. And when we hyper-focus into the companies that are in formal certification processes, we're looking at somewhere between 4 to 5 firms, and they've been able to gather $5 billion of funding. So that's about 60% of all the eVTOL funding that has gone into these companies that are formally in the certification process. So you kind of see where we're at today. Obviously, it's a very concentrated market with the OEMs gathering most of the funding out there. Right, so don't let it fool you that we have public companies in this space, right? The Archers, Jobies, Liliums of the world, they are public, they have billions of dollars in funding, but they are still startups. Let me repeat that. These public companies who are listed on NASDAQ or the New York Stock Exchange, they are still startups, right? And the reason for that is that they don't have any meaningful revenue or recurring revenue that is core to their business models, which is either selling aircraft or operating as a service, the aircraft. Back in Revolution Aero, in San Francisco, the CEO of Airbus UAM put this perfectly, Balkis Sarhan. I don't know if she's here today. She's not here today. She basically said that eVTOL is not a market. It's only a space that we can talk about that is characterized by R&D money and regulatory push rather than commercialization. So if we look at this from a startup perspective, it all comes into a clear vision because here you see the exact startup funnel that is playing out in other industries as well. Only 5% of the startups in AM has actually exited one way or another through IPO or M&A. 65%, so about 400 of them are still early stage. Unfortunately, if you look at the middle, which is the growth and late stage firms, this is the highest risky place to be in today. Simply because funding for these guys is quite dry right now. So when we look at the next couple of quarters, I expect quite significant of companies to, unfortunately, fold over their companies. All right, so you might be thinking, okay, so we're startup land. When are we going to get to a market that we can meaningfully talk about? And obviously, as everybody touched about that today, it's certification, certification, certification. So obviously EHang acquired type certification in China, so I'm not going to touch on them because it's debatable if their certification is applicable to FAA or EASA. So looking at the Western markets under FAA and EASA, obviously Joby is the furthest ahead with their certification plans approved by FAA. We have Archer and Lilium following close by, about to get their certification bases this year. Volocopter, we know that they have their certification basis, but since they're not a public company, we don't know more. And Vertical Aerospace is about to get their G1 issue paper from the UK CAA. So I think, if you look at the $8 billion of funding, this is what it has produced. And I think it's quite a good track record that we are here today. Obviously, more funding will be needed, and the real question that I should be asking next is how much more funding that is necessary to get to the finish line, to get to certification, right? So let's look at the public companies out there, because we know all their data and their financial statements, so we can have a great idea of where they stand today. This is one of my favorite charts. I show this at almost every conference. The green is the liquidity position of all these companies, essentially how much cash they have in the bank. On the right, you see the annual burn. Most of the companies range from $100 to $300 million cash burn a year. And on the very right, you see the runway associated with that cash burn. And finally, their certification goals as stated publicly. So, most of these companies are either have their runways at their certification timeline or they're close to it. But no matter what, they will all need significantly more funding. And I would predict here that, per company, hundreds of millions of dollars more. In aggregate, maybe billions of more, a couple billion. EHang is an outlier here. You might be thinking, with such a cash position, how have they really achieved a type certification in China? This is what I was asking to Andreas Perotti after his panel today. And he basically said that in China, the local governments are actually allowing EHang to access a lot of capital, although it doesn't show up in their shareholder letters or their financial statements, right? So EHang here actually has much more liquidity than is actually reported. So just something to think about. So obviously, we study this in detail, but what do the public markets, what do the public investors think when they look at these companies? Chart is very simple. The share price indexed to December 2021. On the right side, you see their October max share price. And my feeling here is, if we look at here, is that even the public investors are over the hype cycle. Because more or less, these companies are priced about the same relative to each other in a rational way. At the top, EHang, Joby, Eve, and Archer. They're all in a good liquidity position. That's why the market sees that. And if we look at Lilium and eVTOL, Vertical Aerospace, unfortunately, the markets are not looking favorable to them. And in their shareholder letters, you can see why. No reason to go into there. Okay. Sorry, I need to pass these ones. Okay, so the most advanced, the leading companies are public companies, right, with billions and billions of dollars of funding. And you might be thinking, that is a great place. I think it is a good place to be. However, I think if you're at an early stage startup, that's the optimal place. And let me go into the reasons for that. Number one, the macroeconomic climate. If you look at the venture funding across all types of verticals, you will see that early stage, so seed to Series A, is getting really good funding, right, compared to the others. This segment has really the highest valuations, the highest investment size per company. Oh, Yeah. Highest investment size per company. And a lot of attention from multi-stage funds or late-stage funds who have been funding the craziest late-stage or IPOs of 2021 are moving down to the smaller startups. Can we get the presentation back, please? Yeah. Alrighty. So the IPO market is mostly dead. That is why if you're a late-stage investor today, if you have $100 million to spend on one company, let's say a Series D company, you will be tempted to think, maybe I should divide that $100 million into 10 different Series A companies and put my eggs in many different baskets and really time the exit of these companies in the next 7 to 10 years. So that is really the thinking that investors have going for early stage today. The second reason why early stage is a great place to be is because from an AAM certification perspective. Obviously today we don't have, on the Western markets, eVTOL certified. We're in a bear market today, so there's no business model to talk about. When we look at mid this decade, so 2026 is just a representative number there, we might have one eVTOL certified or more with the FAA or EASA, but that's the moment when we can talk about a market. And when we say a market, we will have technology and service businesses that will be formed around that, which means that if you found your business today in 2023, maybe raise pre-seed or seed funding, by 2026, 2027, you'll have Series A, Series B, and you'll be actually generating money potentially with other eVTOL or AM companies, right? And finally, when we look at 2030 and post this decade, this is when we will be in a bull market. This is when we will have the IPO market hopefully fully recovered if history, economic history is any guide for our predictions here. And when we have maybe 3 to 5 eVTOL certified, the business ecosystem will be there. And again, if you have a startup today that is seed stage and you time it correctly, by 2030 you exit your company in AM, right? So that is kind of the thinking here. That's why from a exit perspective, long-term exit strategy, it is a good time to fund a business today. And the final reason why I think early stage is a great place is the fact that there's some indication that we might be approaching a dominant design in eVTOL. And, you know, Mark Henning from Autoflight touched on this, the fact that there's 150 lift and cruise aircraft among 300 different designs. You know, at a company amount perspective, that's true. But if you look at the venture funding that has gone into the different eVTOL configurations, vector thrust leads by far, right? More than $5 billion of funding has gone into vector thrust startups. Anything from tilt rotors, tilt fans, tilt wings, tilt vane, etc., right? And that is 60% of all funding that has gone into eVTOL OEMs. So obviously, there is big investor conviction that vector thrust might be the way forward. And if that is true, then it means that it is a dominant design is coming in, which from innovation theory means that is a perfect time to found a company that is going to service that ecosystem, right? You know, and obviously that has to hold true. Anyways, okay, so the next thing that I want to show you guys is some areas that I see as big opportunities to invest in early stage. Number one, any business model that is around, formed around as a hardware as a service. So this means basically offering your platform, your product, and the software, and perhaps the operations that come along with it as a subscription service. And there has to be a data play on top of that to be able to upsell or cross-sell to your customer. I think that is going to be a big, big area, and there's already investor conviction here in the last, I would say, 12 to 15 months. The second area that is perhaps a longer-term play is the fact that we need to solve this urban communications and data connectivity problem in urban canyons. And what I mean by that is getting reliable, robust data links to drones or eVTOLs that fly at 500 or 1,000 feet above next to buildings, right? Because today, that kind of cellular infrastructure doesn't exist to provide the positioning services that you need and enable, advanced automation or autonomy that we all are striving for. Finally, advanced manufacturing. In the previous panel, we touched on, what numbers of eVTOLs that, the industry should strive to churn out per year. To get to those market sizing numbers that Roland Berger's, Goldman Sachs, McKinsey's of the world are projecting, I think we need to be at a level where at least 1,500 aircraft per year per OEM needs to be manufactured across perhaps 5, 7, 10 different companies by the end of this decade. And to enable that, we need to invest in additive manufacturing and other kinds of automation tools for aerospace-grade manufacturing. So I know I have a few more minutes here. I want to give you guys a final word on raising early-stage capital. No matter what the condition of the economy is at, whether we're in a bull market or a bear market, it is still really hard to raise early stage. And the reason is this. Going from seed stage to Series A is what we call the startup value of death. The startup value of death has a huge attrition rate. Only about 30% of startups make it from seed capital to Series A capital. There are various reasons for that. The transition that you're seeing is that you're going from angels or small-time VCs to larger institutional capital that have higher due diligence metrics that you need to pass through. So this is exactly where my company, Blackbird, supports founders to raise capital. So if you're raising pre-seed, seed, Series A, this is our expertise. My partner, Maxime, he's based in Munich. He also has his own fund called Quartz Capital. So we're also investors ourselves. We know what VCs want to see, especially in this market. So if you're raising capital or know anyone, please come talk to us, and we would be happy to be part of your success journey. Thank you.